So I've been investing in the S&P 500 for the last 3 years, but to be honest, I've never really taken it too seriously or actually put all that much money into it. But that was until I came across this one simple trick, and it really is so simple that got me excited about this ETF again, and recently I've started putting a lot more money into it. And when I saw the results of the S&P 500 last week, I actually topped up even more just this morning. Because I began to realize that if you invest into the S&P 500 using this method, you can actually retire on it much sooner than you think, and also have a bit more freedom and free cash in your day-to-day life while you work up to that point of financial retirement. So, in today's quick video, I'm going to show you why I'm investing more into the S&P 500 and one simple little trick I'm going to be using to get more out of this ETF, how it can help me to retire financially much sooner than I thought, and also how this index fund can give me more freedom in my day-to-day life all along the way. So let's get started. Now, first of all, I just have to thank each of you because a few days ago, Casual Cash crossed over to 20,000 subscribers, which is insane because that's the capacity of the O2 Arena in London where Ed Sheeran has played. We were there recently at a concert for The Killers, so I can tell you that it is a massive amount of people, and I'm so grateful that you all find information and inspiration in these videos. If you don't know, my goal is to hit 100,000 subscribers one day, so if you haven't subscribed already, you're welcome to do so. Oh, and like the video if you can too. Now, the S&P 500 is arguably the most bought and invested in instrument in the entire world. It is the most famous ETF, and the index fund itself is usually referred to as the market because it's often seen as such a good representation of the USA economy in a snapshot. And often the performance of the USA can affect markets around the world, so this one grouping of companies is incredibly important for investors and economists alike. However, the S&P 500 has never really been seen as incredibly sexy, right? It hasn't shown thousands upon thousands of percent gains like Bitcoin or Dogecoin, and it hasn't transformed an entire industry or created self-driving cars and robots and been shot into space like Tesla. No one really says, wow, I invested in the S&P 500 last month and I became a millionaire, right? Mostly true, but at the same time, you probably also haven't heard someone say they lost all of their life savings on the S&P 500 either, or you haven't heard about it crash like the price of Bitcoin or Dogecoin, or even the share price of Tesla that dropped 72% a few years ago and still hasn't recovered for the last 3 years. So we know what the S&P 500 isn't. But let's talk about what it is. And what it is probably the most reliable investment tool for creating long-term wealth in the world. Many of the top investment specialists, including Warren Buffett, have suggested investing in the S&P 500 as the reliable way to build your wealth, both for beginners and experienced investors.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
And even myself, I did a 2-year experiment which ended at the beginning of this year, where I invested in the S&P 500 every month for 24 months, and it ended up being the single best investment in my portfolio. All you have to do is search VOO or the Vanguard S&P 500 ETF on any investing platform like Google Finance and zoom out to its max, and the picture tells its own story. And that story is that over the long term, the S&P 500 has only ever gone up. In fact, there is no single point in the history of this index that you could buy in and not make money over a 20-year period. Even if you bought right before the biggest of crashes, you would still make money over time, and if you invested during the crashes, well, you will be doing great right now. The way it works is this index is a bundle of the 500 biggest companies in the USA, and if any company goes bankrupt or underperforms to where it falls out of that top 500 spot, it gets removed and is replaced by the next company. So you are always investing in big companies in the world's largest economy, and because of that combination, you have a good recipe for making money and returns, especially over the long term. And so when I heard a simple trick that allows you to retire from investing in this index, it got me really excited, which I'll get to right after the sponsor of today's video. Now, you've heard me talk about Brokstock on the channel before and how they offer no monthly fees, unlike some other platforms. But what you probably didn't know is that Brokstock also offers you an incredible 7% interest on your uninvested cash and 10% if you have over 50,000 Rand. I mean, that's worth it just to use to store your savings. But most important of all, if you set up a new account with Brokstock and deposit 500 Rand or more, then you will get another 100 Rand for free deposited into your account from Brokstock within 7 to 10 days to kickstart your investing journey. Now, this is a special just for casual cash viewers only, so if you want to claim your free 100 Rand bonus, you have to use this link in the description only. Then sign up, deposit your 500 Rand, and you get a 20% return right off the bat. So if you want to start investing in the S&P 500 or many other stocks, you're already off to a great profit, and it's a great platform to try out. Plus, it's 100 Rand for free for 5 minutes of work, so another step towards building your wealth. Sign up using the link in the description and claim your 100 Rand bonus today with Brokstock. So here is why the S&P 500 was never too exciting for me. Well, the simple reason is that it pays a dividend of typically between 1 to 1.3%. And if you follow this channel, you know I like passive income and building a dividend portfolio. So I've been investing in VOO and I built a holding in it because I know you need to balance your risk and have some dividend stocks and some growth stocks, some risk and some stability. So I did the diligent thing and invested in it, and right now I have $700 in the S&P 500 and about 21% growth, coming to around $107 in profit. Not bad, but not a huge amount. Then recently I heard about a little rule that changed a whole lot, and it's called the 4% rule. And the 4% rule is a rule invented by a financial advisor called William Bengen in the 1990s, and that's why it's also called the Bengen rule. The 4% rule is a retirement strategy that suggests that withdrawing 4% of your initial retirement portfolio each year, adjusted for inflation, is a way to create a steady income stream that can meet your financial needs all the way throughout your retirement. Now, that doesn't mean you need to be 65. It means that if your income meets your expenses, you don't have to work and you can financially retire and live your life doing whatever makes you happy. And for me, that has always meant creating a passive income investment portfolio that can meet my financial needs through dividends. But now, with this 4% rule, it means that instead of having to wait until I have millions and millions in my S&P 500 and then withdrawing from it until it's empty, by following this rule, I can withdraw from it in a sustainable way, allowing me to withdraw an income each year while still maintaining my asset sum and having it still grow, and ideally not only keep up with inflation, but outpace it. Because the data shows us that the average return of the S&P 500 over its history is 10.7%. So essentially, it means every year you sell 4% of your ETF as a manual dividend to use for your expenses, and with the growth of the index, it should replenish that 4% and still even grow your portfolio by 6% each year on average. Now, here is the exciting part, to me anyway, is that along with its 1.3% dividend, you will then be withdrawing 5.3% in dividends a year from the S&P 500, which is actually more than some of my investments I have bought strictly for passive income. And on top of that, you're getting a world-class index with solid and proven returns over decades and much lower risk than most individual companies. And it means that if you just invest 20 times your expenses, you can financially retire, and that's it. It's so simple, but I didn't say it was easy because it isn't. Otherwise, everyone would do it and no one would have to work. But it is possible and probably will allow you to financially retire much sooner than you would have thought with other annuities and pension plans. But the next part is that you can also do whatever you want with this 5.3% because investing is there to suit your needs. And if all you're looking for is a way to get some extra income for a holiday each year, then brilliant. Invest in the S&P 500 and every year withdraw your 4%, get paid your 1.3% dividend, and you've got 5.3% growing with the market every year for the rest of your life to take a holiday with you and your family. Or if you just want to grow your wealth and have a bit of money on the side for a new watch or new shoes or a nice anniversary dinner, whatever it is, you can still withdraw your 5.3% every year, and on top of that have your capital sum remain there and continue to grow over the long term. Or if you are like me, you can build it up and put it towards your retire early passive income pool. And best of all of this, because your capital sum should remain as it is and in fact keep growing every year, this is something you can also pass down to your kids and possibly grandkids and so on. Can you imagine having your kids inherit financial freedom? It's probably a goal for most parents. Now I have to mention, as we all know, the markets will fluctuate and go up and down in the short or even medium term. In the last 5 years, you can see some years it went up and some years it went down, and we never know which year it is going to be. None of us expected COVID in 2020, but even with those ups and downs, the S&P 500 still grew an average of around 17% a year. And each year it grows, the amount of those 5.3% payments grows along with it. So for me, I'm going to be ramping up my buying of the S&P 500 and continuing to dollar cost average into this index fund, growing my holdings, growing my returns, and growing the value of my 4% withdrawal and my 1.3% dividend so that I can grow my capital wealth and my passive income at the same time. But that's just me. Obviously your investment will grow faster without withdrawals, and maybe you want to do it that way so you reach your financial goals faster. Like I said earlier, investing is there to serve you, and it can be whatever you want it to be. But as always on Casual Cash, I'm here to share some information, some inspiration, and some of my own journey. So guys, that is it for today's quick episode. I hope you gained something valuable out of it. And remember to like the video and subscribe if you haven't already. And I will see you guys next time, as always, on Casual Cash. Cheers.